Hi there traders, this is the fourth video devoted to the futures trading course by the Syscap Trading Terminal team. In this video we will discuss how the futures trading in isolated margin mode differs from cross margin mode. And of course we will consider the risks associated with both styles of trading. Subscribe to the channel and we get to the topic. Remind you that the course is based on the Bybit exchange, but it's also relevant for traders trading on other exchanges, Binance, OKX, Huobi, and so on. We go to USDT perpetual futures and let's discuss what margin trading is. Margin trading is a trading on borrowed funds. When a trader trades on the spot market, he can borrow cryptocurrency from an exchange. The same applies to the margin trading on the stock exchange. There we borrow shares from the broker. To apply the concept of margin trading to futures trading in the original sense is not quite correct. Futures is not an asset but a derivative instrument. Instead of the concept of margin trading, it's more appropriate to use the concept of leverage trading for futures. Nevertheless, the concept of margin has been inherited from the spot market to the futures market. When we open a leveraged futures position, we put up a collateral to support our position. The guarantee is needed to use leverage. This is a service from the exchange. If the market goes against the position and the collateral is burned, we do not have to return anything to the exchange, unlike margin trading on spot. Our loss is the funds we allocated for the collateral. Futures on Bybit and other crypto exchanges can be traded in two modes. Let's choose the instrument, let it be BTC USDT. And futures on Bybit and other crypto exchanges can be traded in two modes. Here you can switch it. Isolated margin mode and cross margin mode. When we open a position in cross margin mode, our entire account becomes the collateral. In the cross margin mode, all our funds in the margin or derivative account can become the margin. If one of the positions runs out of margin, other positions, free funds on the account will be used to secure it. Cross margin takes excess margin from one position and gives it to another, or it makes up for the shortfall with free funds on the account. The calculations take place automatically. In this mode, risk management depends on market movements and the total account balance. If one of the positions slips sharply, it uses funds from other positions. I really want to make special emphasis that in this mode, you especially need to be aware and be very attentive, adhering to your risk management. In this mode, we strongly recommend to use stop losses. The main risk of cross margin is that losing positions can liquidate the entire deposit. If you miss how one position goes down, the whole account will follow it. This situation can be aggravated by excessive volatility, high leverage, and insufficient margin. Plus, cross margin doesn't allow you to limit the amount of margin for each position. Therefore, in the cross margin mode, it's desirable to use small leverages and margin that is a multiple of the position size. So trading in cross margin mode, you should be sure that all your positions are under control. Use short stop losses and never overexceed your leverages. However, in this mode, you of course have much more place for having loss. You can withstand deeper losses per trade if you have enough margin. And of course, you can trade both modes using the Syscap terminal. Now let's turn to the isolated margin. The same principle, and we switch here to isolated margin. Isolated margin is limited to a certain amount for each position. In the isolated margin mode, we manually deposit X amount of collateral on the position. This is more convenient and safer from a risk management point of view. We will not lose more than we stipulate. The amount of margin for each position is fixed but not limited. So we can stipulate different margin on each position. For example, we have $10,000 on our deposit, but we stipulate $100 margin on one position. So we will not lose more than $100. Nevertheless, we have $10,000 on our deposit. So if a position goes into minus, you have to save it manually. You can average the position, close it, or add margin. In any case, the exchange will not help with the position. If there is not enough margin, the position is liquidated. Other positions are not affected. I really recommend to choose this mode if you are a beginner, not to lose the whole deposit. Isolated positions are often used when there is no complete certainty about the trade. For example, to try out new asset or strategy, but not to jeopardize the entire account. Also, isolated margin is suitable for traders with a clear risk management and clear risk limits. For example, if the allowable drawdown per trade is $100 and no more. So isolated margin is perfect for such an approach. The margin is calculated so that in the worst case, the loss from the trade would be no more than stipulated amount of money. Now let's figure out how to stipulate the margin. Here we choose the order by value to stipulate it in USDT. And we, for example, choose 10x leverage, market order, $1,000. Let's imagine we have $500 on our deposit and we stipulate $1,000. We would like to buy futures for $1,000 using 10x leverage, and here we see our collateral, $101 from our 500 deposit. So we risk to lose only this sum of money, not the whole deposit, but only the part we stipulated to be a collateral in our trade. So in this case, here you can see the amount of money you risk. After stipulating the amount of money to be collateral, to be a margin per trade, you can trade through using Cscalp. I hope everything is clear and you will be using this knowledge wisely. Now you know the difference between cross-margin mode and isolated mode. In the next video we will be talking about leverage, how to use it correctly, how to limit your risks, and set up your leverage correctly. Thank you for your attention, see you soon.